Where is it showing you that? Oh, here we go. I think we got it.
I'm showing a live stream on YouTube also.
There we go. Hey, all right, we got it. Let me get you back up here so I'm just looking at you and not everything else here. There we go. It only took us way too long, 5 minutes. That's not long. All right. So thank you, Devin, for, oh, let's do this. I'm going to record this so that we have it for later. So thank you for coming and visiting with us today. Hope you're doing good.
Doing good. Ready to get back to normal life soon, hopefully, and safely.
That would be nice, wouldn't it? Do we know what that looks like anymore? What is normal? Like,
no, well, you and I were never normal, so
that's true.
Our normal.
That's very true. That's very true. Okay, well, you were kind enough to come and talk to us today about mortgage forbearance. I know that you and I feel pretty similarly about this, that it can be, it's a good thing, but it's a dangerous thing if you're not careful. Yeah. So emailed you some questions this morning so that we could ask, but we'll put those, these are things that I thought of. If you think of anything else that people need to know, then of course, go for it and we'll go from there. So, so the forbearance kind of is something that comes through the CARES Act and basically says that if you need it, your mortgage company is to give you time off of your payments for a period of time. Is it up to a year or is it less than 3 to 6 months?
It is up to a year, but the most common responses to lenders is 3 or 6 months, but the CARES Act does allow for up to a year.
Right, okay. It seems like a long time, a year, but people really could be out of work for a long time once this, we don't know really what's going to be happening. So, but with the CARES Act, those loans need to be, the ones that are covered for sure under the CARES Act are federally backed loans. So can you explain to people what that means and what those programs would be?
Absolutely. So the two most obvious that are federally backed loans are your FHA loans and your VA loans or veteran loans. Those are obviously government-backed loans because they are government-sponsored, guaranteed loans. So as far as the others go, Fannie Mae and Freddie Mac are the two, I call them quasi-government organizations. They're backed by, and there's a lot of ownership from the 2008 crash in Fannie Mae and Freddie Mac. So the government owns stock or shares, however you really want to look at it, in those companies. So they're government backed also for the purposes of this conversation. So I provided a couple of links so that you can look at both websites, put in your address and your social security number. It's a legitimate link that Denise, you can share. It will tell you if you're Freddie or Fannie, you have to go to both websites and look it up. And depending on which one comes up and says they're owned by Fannie or Freddie, then you also have a government-backed loan from the CARES Act perspective.
And of course, you probably, I might have missed this. The VA, of course, the VA loans obviously are going to be, VA backed. So, so there goes my dog. I hope that, I don't know if you can hear that or not. She's downstairs. What if the mortgage isn't federally backed? Is there options?
So it's in the best interest of the servicer or the investor of that loan to offer some options, but not necessarily. So if it's not a federally backed loan, for example, the bank statement loans for self-employed borrowers that have become popular over the years, those are going to be owned by individual investors, and you're gonna want to call or go online. I actually suggest across the board that you go online onto your online account with the lender that you pay your payment to, and can read and apply to whatever programs they have available on the website, because calling a mortgage lender for servicing purposes is nearly impossible at this point because of the volume of humans that are in this together right now.
Right. A lot of people all looking for the same information.
Yes.
Yikes. Okay, so can the mortgage company say no under any circumstances?
So no, the mortgage company can't say no under the CARES Act. They actually are granting the forbearance, no questions asked. That's a little bit of sarcasm, but really it's no questions asked. If you have one of those, keeping with the example to keep this simple, the bank statement loan for a investor type loan, if you have one of those loans, the lender can have no options for you. It can be pay your payment, or we're going to send you into foreclosure and default. But no, if you have a federally backed loan, the answer is going to be by default, yes. However, there are many implications behind that yes. And the biggest one is that you are going to be required later. And this is me being very straightforward and different than what you're hearing on the media and from other experts in the industry. You are going to be required to prove your hardship. And in my knowledge in this business, it's going to be pay stubs. It's going to be bank statements. It's going to be, do you have a 401k? Do you have assets that you could have been making your payment and you just chose not to?
Right.
If that's going to be the case, that's where we're going to deal with, you're going to be paying the entire forbearance all in a balloon. So.
Yeah. See, and I think that was going to be kind of coming up here is what, but before that, I guess, is there anything specific? There's nothing specific for just Florida residents. Are we getting anything special because we happen to live in Florida and work in Florida? And is anything different here for us?
Not that I'm aware of. If there is, I'm just simply not aware of it. So nothing special for Florida. I think that the governor's purview is only over things like the toll roads and when we can really get out of the quarantine for specific business types and following the 3-step plan that the president announced yesterday, when he allows that for the state of Florida, that's his purview at this point.
Right.
So.
Right. Okay. So paying it back. Because, you know, forbearance is going to end at some point, and now you've not made payments for 3 months or 6 months. I think I watched your video that you did on your YouTube channel.
Yeah.
That means you could have to pay, if you've got a $3,000 payment, you could have a $9,000 to $18,000 due in 6 months.
All at once. So if you don't prove that forbearance, yes, they're going to call that entire balance due. And if you don't have the money, there's going to be the why. So if you have a $3,000 payment, let's stick with that, and you have $2,000 a month or $1,500 a month, I would say that go into the forbearance, the approved forbearance through your lender, and pay as much as possible so that when they ask you for the documentation and the proof that you had a hardship, that it's obvious on your bank statements, on your pay stubs, that you are working reduced pay. I have many clients that are on reduced hours, reduced pay, 20%, 10%, 50% pay. So if you're paying half your payment and you're working on half your pay, that's obviously okay. So balance left, that once that forbearance has been approved on the after the fact side, not the upfront side, I would say that they're going to offer all of the options available under the CARES Act. So put the rest of the balance across the term of the loan. So 3 years, 1 year, whatever the lender is offering, or all the way at the back of the loan. And then instead of a 30-year loan, you have a 30-year and 3-month loan. Or you can just exercise any other flexibilities they may give you. Those are going to be open-ended. Aside from at the back of the loan or the 1 year spread over 1 year, some people aren't going to be able to afford over 1 year. Maybe the lender's going to allow for 3-year repayment. So I don't want to dig too deep into that. That's a lot of me predicting what they're going to allow. Yeah. Those are those loan modifications. That's not a scary word, but that becomes more of a loan modification at that point.
Yeah, I think that's what scares me most about the whole CARES Act thing is that they've said you have to give this, but they don't really say what happens on the back end of it, how you're supposed to pay it back. They haven't really put any specific guidelines in there. And for me, as a cautious, not terribly cautious person, but cautious enough to say, yeah, that's scary. Yeah.
Yes. It is scary. And I can tell you as a 20+ year veteran in this business that it's going to be basically somewhere in that bracket of what I've described. Prove it and then pay it in one of these A, B, or C ways. And none of it's going to be super friendly because that's just not the way finance or banking works. And I was a survivor, as I joke, with Washington Mutual Bank, and then another bank that I worked at after that. I saw both of them putting those types of aggressive policies in place to defend the bank and the liquidity of the banking system,
Right.
lines of credit to protect those things. So there are lenders like my company who have mortgage lines of credit that we operate on, and we have to protect that so that the bank doesn't call it and turn it off so that we can continue to do business. So
Right.
it's going to be the same thing on the servicer side, that this, what we're talking about. They need liquidity. And so they're going to defend their business. They're going to take defensive actions, as I call it on my YouTube video, to defend their business from bankruptcy, quite frankly.
Right. So, and their first, I know that I put this in the newsletter that's, I think, due to go out tomorrow, that their first interest is the banks,
Yes.
not the borrowers.
Not the borrower.
So, yeah, they really don't care if you can't pay it back. They're going to get their money one way or the other.
One way or the other, or the house, which
Yes.
we like to say that they don't want your house, but they took lots and lots and lots of houses after 2008.
They did.
We know how true that is not.
Yes.
So.
Yeah. Okay. And so you talked a little bit about, tacking it on the back. Is that what they're talking about, the mortgage deferral, the payment deferral program that's supposed to start in January? I was reading a little bit about that, but I didn't go too far into it.
So the names that they're giving these things cause confusion, in my opinion. I like to keep things at a very basic level when I talk on my videos on my YouTube channel and today. The title of forbearance, or whatever name they want to give it, it's basically at the end of the loan, is at the end of the loan. If it's re-amortized over a year, if it's re-amortized, which means taking what you owe at the end of your forbearance and dividing it by 12 months or 36 months, then that's going to be what it is. And that's generally going to be called a modification, but important. It's just understanding what you're agreeing to, especially before you stop making payments now. If you can't make your payments, then you can't make your payments, but you will be required to prove it. I think that's the most important part. What happens on the back end can be a collection of many different things depending on your situation. So I would be ready for anything, including the worst case, which is a balloon of all of it.
Right.
So.
And do you know, are any of the servicers at this point telling people, okay, you can take forbearance, here's what it is, here's what we're going to ask for at the end? Or are they just saying yes and we'll get back with you in 6 months?
My understanding is they're saying yes, and we'll get back to you in 3 months or 6 months.
Okay.
And
it would be nice.
Like you and me having, you and I having this important conversation now, my YouTube channel where that's available also, that it's a TBD.
Right.
TBD. So but being in this business, we know what the options are going to end up looking like.
Yeah. They're going to want their money, or they're going to want the house.
Right.
And that's what we want to. So it's going to be a restructure, a modification, a refinance, a foreclosure, something like that is going to be. And let's see. All right. So then I think the other big thing is that if you take this, how's that going to affect people's credit?
So for the 30 days, the 90 days, the 6 months, during that forbearance period that's granted, it won't affect credit. If you don't comply with whatever the bank determines your repayment is, then delinquency is going to hit your credit. Then the foreclosure process can start hitting your credit if you don't comply with what they've requested. So that's where it becomes damaging. However, I will tell you this from my insider information. If you go into forbearance now and you want to take advantage of the amazing interest rates, which are in the 2s and 3s right now, you will not be refinancing. You won't be qualified. We will be disqualifying anybody in a forbearance during this time from a refinance, and purchase if you're looking to sell and purchase.
Right.
And how long that goes on, these types of things change on a daily, weekly basis. It's unbelievable how that might be our posture in this business right now. No loan, no refinance for you because you took forbearance. And then maybe after 6 months or 90 days, it's okay.
Of making your payments on time.
Yeah.
So you can
Yeah.
see a payment history.
Yeah.
Right,
Yes.
right. So is it a better thing then? Because by the time you refinance, you're going to have a good 6 weeks of time between, 4 to 6 weeks between payments where you're going to be kind of payment free. Is it better to go ahead if you think that your money situation is going to be short term? Is it better than to go ahead and just say, hey, let's take advantage of those rates and refinance now instead? My credit's good.
I wish that it was, but we're actually going to be requiring that our buyers and our refinance clients attest to in writing your financial stability and your job stability at closing.
Okay.
So you don't want to enter a refinance or a purchase without being truthful with the lender. Again,
absolutely.
Aggressive action. I would expect some aggressive action for those types of misrepresentations. I don't want to say anything other than misrepresentation. So if you know your job's on the line and you go and close a refinance or a purchase, you could find yourself in legal trouble.
Sure. So I mean, that's because there's somebody out there that's thinking that might be a good course of action. So we want to caution people. So alternatives, are there any alternatives to forbearance? Obviously, make your payments.
I would say make payments. So we're in many of us are in commission jobs in the real estate industry, and we're used to going lengths of time without income. And if you have resources like we do in the real estate business, we have buckets of money that we have for just in cases. I think buckets. Because we can go a month or 2 months without a paycheck, especially if I go on one of my trips to Aruba.
Exactly. Yes. Yes. One of these days you're going to take me with you.
Yes. Yes. Absolutely. That would be trouble.
It would be.
And so if you have resources, 401k that you can borrow from, an IRA, actually there are provisions in the CARES Act that allow you to take up to $100,000 out of your IRA or 401k and pay it back within the next 3 years. And borrowing from yourself on a 401k or an IRA is interest free. Right. You're paying an interest rate to the 401k company or back to the IRA, which I don't think that works like that. But let's just say they did name an interest rate. The interest is paid to you on all 401ks. It's actually not paid as a fee to the lender. Right. So 3 years, no penalties. Normally a 10% penalty plus your income taxes. So there's neither the penalty nor income taxes as long as you get that last dollar back in there within 3 years. Right. So that would be the way to go. Pay your payment, even if it's from your IRA or 401k. Yeah.
And a lot of time, those employer-backed 401ks, they'll just take that money right out of your check. So, you just, you don't see that money. It's just 50 bucks gone or $100 gone out of your paycheck every week. Yeah. So that works out pretty nicely then. Okay. So
Agreed.
That pretty much covers all of the questions I had about forbearance. Like I said, it's a program that it makes me very nervous just because it can get people into trouble.
It will get people into trouble. So unfortunately, we can't make people watch these types of live streams and videos, understand what they're getting into. They'll listen to their neighbors or their friends, co-workers instead of professionals in the business. But as long as we're making this effort to inform people truly what's going to happen, we've done what we can in the industry. Absolutely.
Right. Okay, well,
All
I
right.
am going to shut it all down at this point.
All right.
And thank you very much, Devin, for coming and talking to everybody today and explaining to that and answering all of my silly questions. As you know, I'm the queen of silly questions. I like them. Thanks a lot.
Thank
And
you.
hopefully we'll get to see each other in person again soon.
Yes, soon. Yes.
Yes, that would be
All right.
fun.
All right.
All
Well, everybody
right.
have a great weekend and take it.
Yeah.
Be healthy.
We will. You too.
Thank you.
Bye.
Bye-bye.
Okay, stop live stream.